Troy Gayeski, it's simple. Macro's underperforming. Is the game over in guesstimating the Fed and gaming a portfolio performance off economics?
Well, it's very hard to add value in liquid efficient markets, right? I mean, that's been the case for quite some time. When you think of macro managers today, they're better off adding value in emerging markets. That's where we've seen consistent outperformance. There's only a few managers that actually focus on that, however. So as an investor in hedge funds, your opportunity is somewhat limited. But we've always said, I mean, look, very, very hard to add value in the dollar-euro, very hard to add value in guessing next Fed policy. So we do think, for the most part, it's a challenging environment for macro managers. That being said, as we've talked about before, we've been in an uptrend. The Fed's been expanding their balance sheet. They've cut rates dramatically. That is the consensus trade amongst macro managers in the U.S., of which there are far fewer now. James Gorman of Morgan Stanley telling Tom and myself just yesterday, it's QE. Yeah. Is it QE? It is QE. I mean, so many people disagree with that view. Look, it's very simple. We came into last year. It was January 2nd last year, went on your show, and all the Fed had to do was nothing, and markets were going to rebound. But in order to keep powering this rally further, they're going to have to continue to expand their balance sheet. But it's dangerous territory, right? Because they're running the medium-term risk of asset bubbles in order to further dampen the risk of near-term recession. It's a trade-off that they're well aware of. See how he does that? He slips into economics like that. It's nice. What's so important is that, folks, this is one of the social high points of the year. Mr. Gayeski and some others at Skybridge host truly a gentle, wonderful, elegiac wine party. Is that what it is? Everyone attends, and it's in 2 rooms at the Hotel Europa. One room is the boom room, and the other room is the bust room. Which was more attended this year, the boom room or the bust room? Unfortunately, neither one of you attended, which really bummed me out on a personal level. We were down having pizza with the limo drivers. Music to the ears of our bosses who are listening to this. Yes, yes. We didn't go to the party. No, to Tom's point, they're working hard, everybody. They're working hard. There's a big conversation about some comments made on this program by Bob Prince of Bridgewater. Let's listen back. 2018, I think, was a lesson learned. The tightening of central banks all around the world wasn't intended to cause a downturn, wasn't intended to cause what it did. But I think lessons were learned from that. And I think it was really a marker that we've probably seen the end of the boom-bust cycle. The boom-bust cycle, as we know it, is over. Bob Prince of Bridgewater, your reaction? It's insane. I mean, boom-bust cycles. May we quote you on that? Feel free. I mean, I was actually shocked at the end of each day. I go through a news roundup, and when I saw that, combined with the statement of Ray Dalio that cash is trash and all risk assets are going up, you step back and you wonder if when the bearish guys, Bridgewater's been very bearish, start to get that bullish, it could be a dangerous development. So many ways to go. And I want to make clear, Mr. Farrow's the one who instituted this boom-bust debate. And there was, for those of you that aren't up to speed with the social flow of what we do on Global Wall Street, the response was huge to this interview last night. You said in saying Carmen Reinhart was a little more graceful, and Mr. Gorman finessed it with fear and greed. What do the investors of Bridgewater do? How do institutional investors respond when they hear that on Bloomberg Surveillance? Well, look, I mean, Bridgewater's an incredible firm, what they've built, and they have many different views within the firm, and it's really a systematic investing strategy. So if they go on TV and say one thing, that's not necessarily how they're implementing their strategy. But at the same time, it's really shocking that because we've been through several periods, wherever we have a downturn, central banks respond, they elevate asset prices, that you would then take that to the conclusion that we're not going to have boom-bust cycles anymore is somewhat stunning, because we all know if we end up in bubbles, whether they're in commercial real estate, corporate credit, or equities, the downturn will be that much more severe. Well, it's the financial dislocation that I think is important here. But allow me to take the other side of this, just for the purpose of this conversation. When Bob Prince talks about central banks being boxed in, just this thought that if they ease, they can't stimulate the economy anymore. But they can't tighten because you see what happens almost immediately. So we're just stuck with stagnation and things go nowhere. Are you a little bit more sympathetic with that view of the world? Oh, 100%. Yeah, I mean, central banks have been boxed in for quite some time. I mean, it was actually funny when you read the ECB's comments about how they're going to maintain QE until they start raising rates.
when is that going to be? When I collect Social Security? I mean, come on. Like, the soonest the Fed is going to hike is Q1 of 2021, and the ECB would probably be 5 years behind that.
You hold your fancy conference, which I'm not invited to. I understand.
Come on,
Great.
Tom,
you got 2 and 20, and it's coming down and all that. How does alternative investment add alpha, add value, add dollars to a portfolio with this leaden state, with this new low volatility?
So we think right now the key in our business is to try to be a true alternative to equities and fixed income. We've said for
what are you doing? Oriental carpets?
Maybe that's next year's trade. But the point is we've said for the past years the only way to keep up with equities is to be 100% long equities. The only way to outperform is to be levered long. So how can you add value? You can add value by outperforming fixed income and having a low beta to equities. So if we can grind out mid to high single digits and have much less downside, which
sounds like what Bob Prince said yesterday.
Which are fairly, he's a smart guy. Most of what he says.
How do you do that in fixed income?
Yes,
right now?
well, we're focused still on multifamily CMBS and RMBS and the mezzanine part of the capital structure. And so the beauty there is if we have a downturn, you have far less downside than
Troy,
real estate equity investors, but you still have reasonable return in the meanwhile.
Okay, mezzanine this, mezzanine that. They're looking at their portfolios going, how much Apple do you own?
Well, Apple's easy to own, right? You certainly don't need to pay anyone any money to own Apple or Google or to own the S&P, right? So
you want to earn the fee.
Yeah, well, you want to add value, right? And unless you think, again, if you think boom-bust cycles are completely over, go 100% long equities, be levered long equities, but eventually you're going to pay the price. In the meanwhile, most investors do have fixed income, and that's going to continue to be very return challenged given how low rates are. So that's what we're really focused on, being more of a replacement for fixed income than a replacement for equities.
This conversation's gotten too fancy for me. I mean,
Come on,
John,
man.
help me out here.
We didn't talk about Gamma or Delta.
We welcome you on Bloomberg Radio, Bloomberg Television, to Pharaoh's The Real Yield. It's an early edition.
Oh,
Go.
Thank you for the plug. 2016, when we sat in these chairs in Davos, Switzerland, there were some real concerns about the economy. This time, 12 months ago, some similar concerns as well. It's not certainly January 16, January 19. This reminds a lot of people of January 18.
Yes, correct.
That resonate with you?
It's not quite as bullish. I mean, when you came into January 18, you had just outright euphoria over tax reform, right? And even though the Fed was tightening, you had equities get to 18.5 times forward earnings. So we think that scenario or that time, it was much more euphoric. Now it's more of a recognition that recession risk has gone down. U.S. consumers in very good shape. Donald Trump is almost a shoo-in to be reelected. And so when people look at risks, it's like, what's the risk? What's the risk? And in the background, you have the Fed. That's why, again, many think markets will continue to trend higher.
What will be the hedge fund strategy that will make people look good over the next 12 months? There's a raging debate on this.
Yeah, well, look, I think
long short.
It's not long short still, because even though there have been several periods in the post-crisis where there has been alpha added, the problem is once you subtract fees and expenses, even 1 in 10, right? Even if you make 10% from beta,
in this
another
new
100,
leaden environment.
Yeah, 100.
So which one's going to work? Just because we're going to be out of time.
So we still think structured credit looks very attractive.
Yeah.
Again, if you're trying to make a mid to high single digit return, because the fundamentals of consumer credit and housing credit continue to improve. And the fundamentals of regional community banks.
Tesla made high single-digit return in
Have you
what,
seen
12
that?
days?
In 12 minutes.
Before you go, in the 60 seconds we have left, as a market participant, leaving the World Economic Forum in the next 24 hours, number one takeaway?
I think the number one takeaway is that if you're holding your breath for Europe to restructure itself and become more competitive with the United States, you're going to hold your breath for a very long time.